Welcome back, everybody. So, next, he is a futurist and entrepreneur working on the next generation of financial services. He is the global fintech co head at Consensus, a blockchain technology company building the infrastructure, applications, and practices that enable a decentralized world. He focuses on emerging digital assets, public and private enterprise blockchain solutions, decentralized finance, and autonomous organizations. He is a regular speaker at industry conferences such as Money 2020, Lend It, Invest, T3 Enterprise Edition, and Consensus. Global FinTech co-head at Consensus. Please put your virtual hands together for our man, Lex Sokolin. Welcome, Lex.
Hi, thanks for having me. That's an exciting introduction for a stream from a couch at home.
Take it away, my man.
Great. Thanks everybody for joining, and I'm excited to walk you through and share some thoughts. It's a little tough because I don't have an interaction very clearly, but I will through a concept of where DeFi really comes from and how to put it into sort of like a broader framework for fintech and kind of the technology evolution that we're all participating in and seeing. So it is a DeFi conference, but I think it's really important to understand how these things come together and what are the underlying driving factors. And as was said in the introduction, I work for Consensus building out financial software that intersects with blockchain. So obviously check us out at consensus.net, and I'll talk more about that as well. Okay, so we'll cover four number ones. We'll cover four things: the fintech progress to date, the journey along the crypto maturity curve that brings us into DeFi, the decentralized autonomous organization of finance, and then I suspect we won't make it to any of the products, but they're there for reference. Okay, so the first observation is, where does finance sit in terms of the overall economy? So these two charts show you that over the last 20 or 50 years, there's been a shift from manufacturing economies far more into services economies, and finance is somewhere between 20 to 25% of GDP. So when you think about how much of a share in a generic system finance should have, that's your anchor, somewhere around 25%. And then when you look at venture capital, historically, over the last decade at least, what we saw was a really significant shift of funding into financial technology. So, in 2007, if you look at venture capital, something like 5% of VC was allocated to finance. 23% of public companies were financial companies. And then over time, that has equilibrated to both be around 16, 17, 15%, depending on if you're looking at Ant Financial or not. And of course, private investment has also ballooned, which is the light blue bars on this chart. So why am I talking about this? And the answer is there's been an incredible tailwind. It's never been easier to build financial technology and innovate. The vector of attack that most fintech firms took was to unbundle the bank experience. And so this is a slide, or this is an illustration that's probably at this point a decade old in concept of taking out a bank, decomposing it to parts, and creating startups that do each one of the things on that screen. So here you see Wells Fargo falling apart into its various component bits, and many of these names today are either a unicorn or completely worthless. And so this decomposition then started to create fintech champions that were competent in lending, like SoFi, or trading, like Robinhood, or wealth management, like Betterment, or banking, neobanking, like Revolut or N26. And creating these vertical champions that saw a lot of blitzscaling VC money to stand up and serve millions of, let's say, users, perhaps customers. However, the economics of that didn't really work. And so what the unbundled feature companies started doing is adding back in other adjacencies, right? So you would have banking from trading companies and trading from banking companies, um, insurance from lending companies, all of this stuff coming together back into that bundle that was being pulled apart before. And of course, the large banks have done exactly the same thing in trying to compete through feature matching and trying to compete through price wars. So, Robinhood has a JP Morgan alternative, Lending Club has a Goldman Sachs alternative, Starling Bank has a has a RBS alternative, Betterment has a Merrill Lynch alternative, and so on and so forth. The point being that sort of the value of the fintechs started to get eroded by the large incumbents, and today it's also being very aggressively eroded by the tech companies. So uh, Google has multiple banks that it's working with in order to offer Google banking and payments. Samsung has partnered with SoFi. Apple's partnered with Goldman Sachs. Obviously, Facebook with Libra and its attempts around stablecoins. So the competition space has massively increased supply of financial products. In the past it was here's a licensed institution and they manufacture the thing, and now it is everybody's distributing financial product, which is creating a collapse in the price across the board, whether it's in wealth or in banking and money movement and so on. So we're not even in crypto yet, right? Like this is still the existing ecosystem, the fintech ecosystem, and so basically the whole human continuum of what is it that you do with money, from paying to saving to lending to trading to investing to retirement to life insurance, has been digitized into a front end and put into the phone. And you can kind of argue that um, most of what we've seen in the last decade is just putting finance into the phone. And the East has been, particularly successful at this in a way that we haven't necessarily seen in the West to the same extent, which is not only is finance in the phone, but the entire ecosystem uh, of commerce, of social engagement, of entertainment, of transportation is organized around the financial identity. It's not organized around the social identity the way it is in the US, for example, around Facebook or Twitter, or it's not organized around the hardware company like Apple and its OS. It's organized around the financial identity. And so this tells you what the promise could be. So we went through this background of massive tailwind in the industry, lots and lots of supply, mostly focused on distributing existing packages. But it still doesn't feel like anything's fundamentally changed about what a bank account is, or what an investment account is, or any of these things. And so, the thesis that I have and that we're implementing in Consensus Codify is that distribution may have democratized access and become this cliche, and perhaps there is industry efficiency happening in the middle office of 20% off here, 30% off here on trading systems or CRMs. But the manufacturing of financial products is largely the same as it was 50 years ago. How you make a bank account and what that means. And without a disruptive change at manufacturing, you can't really distribute anything. So the only reason you have Spotify is because the music file is digital. You can't have a Spotify of CDs. And similar for all of these other sort of cliche examples, right? You can't have Netflix based on video cassettes. It doesn't make any sense anymore. And so you need the same thing to happen at the manufacturing layer in financial services. And largely, we believe that programmable blockchain networks are this answer for finance manufacturing, for all the reasons that you've already heard in this conference around the architecture of the blockchain, the composability of the various protocols, the standards, the out-of-the-box security, the audit functionality, the enforced property rights are all things that support the financial services and sort of commercial industries. And increasingly, Ethereum's the answer for how that happens. So this is my favorite chart about Ethereum. It's not the price, it's not the value locked, it's not any of the sort of financial metrics. It is how much is Ethereum executing software. And so, yeah, you can see that per day, something like 2 million contract calls um, happen on the Ethereum network. And so this is the hum of the machine that is running that financial infrastructure of the future. Okay, went pretty fast, covered a lot of stuff. Time's short, so we got to do it. In the next section, I talk about, okay, so let's say we agree and we start from the point of let's re-engineer the heart of what the finance industry sits on. How do we get there? And so, you kind of have to come into this question with a belief of if it is the answer, what are the paths that we're going to travel in order to get to the other side? And so it's not immediately everything, right? There's a transition period and there's disconnects and there's sort of a lumpy ladder. So you start first at enterprise blockchain, which focuses on mutualizing data and the workflows around that data. And then once you have the data sitting for the industry in a common place, then you can get to tokenization and the packaging of assets into digital assets, into tokens. And then once you have the tokens, you can start thinking about how to package them for consumption more broadly. And also, how does the software that used to be used for rebalancing or underwriting or any of these other things as they relate to standing up finance, how does that software move to the network itself? And then finally, how does that software interoperate? Right? And that's when we get into DeFi. So it's a long way to tell the DeFi story because it puts it into the context of the evolution of uh, the entire fintech industry uh, over the last decade or so. So enterprise chains, probably not the reason you're at this conference, but there is ongoing movement and deployment of private chains, and they are largely, on this chart on the right, you can see 40%, the largest swath, is focused on finance and insurance. The next kind of chunk, which isn't as easily articulated here, but is supply chain. So those are the core uses at the data layer. And then the digital asset layer is primarily around specialty finance. So things like private equity, real estate, um, muni bonds, derivatives. So things where markets are not as papered in the traditional world and there's opportunity. But that gets us to the interesting thing, which is the DAOs and DeFi. And I think in the other talks here, you'll get a lot of context of what a particular protocol is doing and how it's seeing its economics. But I want to put this chart up because I want to remind you of that chart of the bank being torn apart into lots and lots of little composable bundles called fintech at the very beginning of this talk. And the same thing is now happening to whether it's fintechs or banks or the tech companies, but it's happening from an open source perspective, from the perspective of uh, decentralized finance, and largely these decentralized applications are focused on lending and exchange, and then increasingly the other asset classes as well. And so this is a neat visualization that Consensus produces out of its DeFi data store of mapping the commercial activity between the protocols on DeFi. So on the left, you see 2019, and on the right, you see the internet of the 1970s. And then, of course, as the network grows, it increases complexities, right? So the 1998 internet, not the 2021, but the 1998 one, you can see over 20 years has become this rapid creature of connection between cities and nodes and universities and so on. And on the left, you see also an increasing sophistication and interconnection of DeFi protocols. So going from an exchange to a lending protocol, or going to an insurance protocol, and so on. And these interconnections create economic activity between players. You can also say it's self-referential, and you can certainly create criticisms for leverage and sort of the fragility of the network. But regardless of that, the specialization is what creates an economy, and it creates software which is then generalizable. So even if we have self-referential assets today that are trading on these networks, in the longer run, it's important to understand that each of these points and these nodes are that financial software I've described that would move off of traditional infrastructure into the open protocol. So I'm going to land us at examples of what I mean by financial software because people often kind of like these are invisible things, but a company like WorldPay, which enables the checkout experience for Visa, so payment processing experience on the left, identical to trying to buy something with MetaMask as a human being. It's the same action, and the thing on the left is worth $35 billion. On again, core banking. So a company called Jack Henry. There's also Fiserv and FIS in the US. This is infrastructure on which all of the banks sit. This is how they open a bank account. This is how they make a payment. I picked Maker as an example, as a comparison for infrastructure that enables savings and an embedded savings rate. There are other comparisons we can talk about, but conceptually it's analogous. Lending and underwriting. We all know Compound and the other lending protocols, right? So Finastra is a collateralized lending software company, helps bank underwrite in their cloud offering. With a beautiful, beautiful screenshot on the left, and it's a $5 billion company. InvestNet, portfolio management, trading, rebalancing, analogous to SET. NASDAQ, of course, not only creates the venues, but also has the software which run those venues. You can pick any decentralized exchange as an example. And then you can get into derivatives, right? So whether it's synthetics, vis-a-vis something like TradeWeb, which is a $12 billion software and venue provider, and so on. And so you can see that the protocols are today perhaps relatively small to traditional market sizes, but they are replicating existing multi-billion-dollar financial middleware. And they also come embedded with the financial assets that travel on them. And so there's not this kind of distance between the capital and the software that there used to be. And so the question is, where will this go? I think there is a straightforward answer, which is today a lot of it is flowing into user aggregators, which pull different DeFi protocols together. I think very soon we're going to see these within the fintech apps. So this is a chart of showing millions of users for the fintech apps, from Robinhood to Circle to SoFi to eToro to Coinbase to TransferWise. And these are the companies who I think will likely outcompete a lot of the aggregators, or perhaps will purchase the crypto aggregators. Revolut, SoFi, and Robinhood are already simple examples, and there's just a regulatory barrier in terms of their participation. And then, of course, finally, there's a high chance of much of this financial infrastructure being run or supported by governments in the long run. So the 20-year time horizon, and this already exists. We just think of it in a slightly different way, like the ACH network, which the Automated Clearinghouse network run in the U.S. with a 55.8 trillion transaction volume in 2019. Or similarly, if you think about the federal agencies that underwrite mortgages in the U.S. and the trillions that go there. And of course, already we know that for China, both the CBDC effort that they have and the BSN blockchain services network that they have is going to put a lot of pressure on the U.S. to try and catch up. Okay, that was a ton of information, but hopefully it gave you the arc and the direction of travel from how did fintech come to this place where we are today, how it grew to fill its natural void in the private ecosystem and the innovation kind of game between all these different players, and then where we are today in terms of the crypto maturity curve, going from enterprise to digital asset to now DeFi, with DeFi developing the software that is essentially standalone inside of an open source programmable blockchain network. There's one question I'll take before hopping off. Is Ethereum really capable of handling all this? A simple CryptoKitties game crashed the network in a day. Surely DeFi is much bigger. So this is something for sure that is, I'm telling a rhetorical journey. There are specific answers for how this stuff stands up. And so the specific answers would be, for payments, you would have one certain type of scaling solution. For like large, high-frequency data sets, you might decide what you want to anchor on Ethereum and what you might not. And so for sure, you wouldn't want to shove all your data into the pipe today. you can think of it as kind of like Real Player in the early 2000s versus YouTube, or Instagram today, where Real Player had the right idea about the internet being all about video, but was not able to either deliver on the bandwidth or have the content or any of the pieces that were necessary for a YouTube to flourish. And so we are definitely early on in the execution of the technology, but I think the concept is as bright and as correct as could be. And then the follow-up question, of course, is Ethereum 2. And I think a lot of folks expect Ethereum to be able to scale by having networks attached to it that have different performance characteristics, right? So if you have a social media or a gaming type set of demands versus if you have a wholesale payments type of demands, you might have different performance characteristics of things that plug into it. I think it's going to be a multi-year journey. The key about the Ethereum 2 economics is to get the network bootstrapped to a minimum scale. And I think the way that the community is going about that in terms of getting early validators on board and so on is going to be able to kind of hop us over that initial barrier. And then once we're over it, this concept of DeFi will be just like embedded at the core into the network with with a yield that the network itself generates, and then all of the experiments and the early entrants that we have today will be able to build around it. I think even more in even more interesting ways. Okay, thank you everybody for your time. I know we're out of it. If you want to check out more, see either consensus.net or codify.consensus.net, you can grab me on Twitter at Lex Sokolin. And thank you for your time. Take care.